Ladies and gentlemen, today I want to peel back the curtain on silver, not the silver you think of when you hear precious metal, but silver as the silent powerhouse fueling the technological and energy revolutions. Over the past several years, silver has quietly shifted from being a secondary precious metal to becoming a linchpin in the global industrial economy, and the supply side is simply not keeping up. The silver market is now characterized by a structural supply deficit, not a momentary blip. In 2024, demand outpaced supply by 148.9 million ounces, marking the fourth straight year of a physical shortfall. The Silver Institute plus 2 Silver Phoenix 500 plus 2, when you aggregate the deficits from 2021 through 2024, you arrive at a staggering 678 million ounces, roughly equivalent to 10 months of global mine production in 2024. The Silver Institute part of why supply is so constrained lies in the structure of silver production itself. Much of the world's silver is not mined from primary silver mines. Instead, it comes as a byproduct of base metal, lead, zinc, or gold mining. Metal News plus 2, the Silver Institute plus 2, that means even if silver's price surges, you can't simply dial up silver production in isolation. Instead, you're subject to the incentives and cycles of other metals. This byproduct nature makes silver uniquely unresponsive to silver's specific demand signals. The World Silver Survey reports that primary silver supply from mines where silver is the main extract continues to decline, even as byproduct production rises more slowly. The Silver Institute exploration and capital investment for new silver-specific mines have been underwhelming. Over the past decade, there has been chronic underinvestment in exploring high-grade silver deposits. Metal News, meanwhile, existing mines face declining ore grades, pushing down the yield per ton of ore processed, and raising the all-in cost of production. Metal News plus 1 environmental and regulatory challenges further complicate the picture. Launching a new mine is a long, capital-intensive process, often with major permit and social hurdles. Metal News recycling helps, but it's not closing the gap. In 2024, silver recycling reached a 12-year high, about 193.9 million ounces were recycled, an impressive number. Afri-Swiss commodities, but even with this push, total supply mine production plus recycling can't keep pace with demand from consumption. And that's because demand is not static, it's accelerating. Another contributing factor, many major silver mines are already operating near capacity. According to analysts, all the largest silver mines are either at peak capacity or close to it. Agbi with limited room to scale up in existing mines, any meaningful increase in silver supply would require the development of entirely new projects, and those are slow and costly. The pipeline of new silver mines is thinning, and rising costs are discouraging marginal producers. Agbi, there is also an element of diminishing returns on recycling. While industrial scrap recycling grows, much of silver's industrial demand is locked into applications like photovoltaics and EV, where silver ends up embedded in long-lived infrastructure. Once used in solar panels, for instance, that silver may stay off the market for decades, limiting how quickly recycled supply can recirculate. On top of all that, macro pressures are intensifying. Energy costs factor heavily into mining economics, and rising energy prices push up the cost base for silver producers. Agbi skilled labor shortages in mining regions further weigh on productivity. Notably, many of the base metal producers that supply silver as a byproduct are also grappling with their own headwinds, which reverberates into silver supply. In other words, the silver supply deficit today is deeply structural. It's not something that can be fixed in 12 months by ramping up production. It's baked into the economics of how silver is produced, where it comes from, and how it's recycled. Even as mining companies inch up output, global mine production rose modestly in 2024 to around 819. 7 million ounces, the Silver Institute. They are doing so within severe constraints. That marginal increase, while positive, is far too small relative to the scale of demand growth. This structural gap between demand and supply means that silver is not just a cyclical play on precious metals. It is increasingly becoming a core industrial, precious hybrid. And in such a regime, the persistent deficit creates a powerful tailwind for silver going forward. When we look at silver today, the most misunderstood aspect of its market isn't its monetary role. It's the extraordinary explosion in industrial demand that is reshaping the entire supply and landscape. Silver has evolved from a traditional precious metal into one of the most essential inputs for the technologies defining this decade. And what's remarkable is that this transformation is not cyclical. It's structural, driven by long-term technological adoption curves that rarely reverse once they reach critical mass. Consider solar energy. The photovoltaic industry has emerged as one of the most powerful engines of silver consumption. Solar cells rely on silver's unparalleled conductivity to convert sunlight into electricity with maximum efficiency. As solar deployment accelerates worldwide, pushed by falling costs, regulatory incentives, and the global mandate to decarbonize, the silver intensity per panel has begun to matter in ways few analysts fully appreciate. Even as manufacturers attempt to thrift silver usage per cell, the rate at which global solar installations are scaling more than offsets those efficiency gains. Once a technology moves down its cost curve, adoption accelerates exponentially, not linearly. In that framework, silver demand from solar does not merely grow, it compounds. Then there's the electrification of transportation. Electric vehicles are not just cars with batteries. They are mobile electronic systems loaded with sensors, wiring, computing hardware, power electronics, and communication interfaces. Silver is embedded in nearly all of these components. And as vehicles evolve toward autonomy, the electronic content per car increases dramatically. Every jump in computational power, sensor density, and communication throughput increases the demand for materials that conduct electricity and support high-frequency data transfer. Silver sits at the top of that materials hierarchy. The more intelligent, connected, and electrified vehicles become, the more silver they require. We are also entering an era where computing architectures themselves are changing. AI workloads, data centers, 5G infrastructure, and high-performance semiconductor systems rely on materials that ensure speed, efficiency, and minimal signal loss. Silver's physical properties, its unmatched conductivity, reflectivity, and thermal performance make it indispensable in components ranging from switches and solder to advanced chip interconnects. As AI accelerates, so does the hardware that powers it. And when hardware accelerates, demand for the materials inside that hardware explodes. Silver is one of those materials. What often goes unnoticed is how widespread silver's integration has become across everyday electronics. Smartphones, LEDs, medical imaging equipment, consumer appliances, and even emerging wearable technologies all use silver in some form. These may seem like incremental sources of demand individually, but collectively, they form a persistent and rising baseline. In a world where every device becomes smart, interconnected, and energy efficient, materials with silver's unique properties become essential rather than optional. Another underappreciated driver lies in the electrification of industrial and commercial infrastructure. Renewable grids, battery storage systems, power management devices, and high-capacity transmission networks require materials that can handle high power loads with minimal losses. Copper may form the backbone, but silver is vital where performance cannot be compromised. As grids modernize and expand to support distributed energy systems, silver's role scales alongside the infrastructure itself. Even in emerging sectors, like printed electronics, advanced coatings, antimicrobial applications, and next-generation sensors, silver is being woven into the fabric of innovation. These industries are in early growth stages, which means their demand curves are not yet mature. They have the potential to grow at multi-decade rates, and with them grows the industrial draw on silver. What's critical to understand is that industrial demand for silver is not optional. It is not driven by sentiment, investor flows, or safe haven positioning. It is dictated by physics. Silver does what no other metal can do at scale. Substituting it is either too costly, too inefficient, or technologically limiting. In markets shaped by exponential adoption, solar, EVs, AI hardware, electronics, and grid modernization, materials with irreplaceable performance characteristics do not see linear demand growth. They experience demand shocks. And silver is now in the middle of one. In every market cycle, there comes a point where capital begins to recognize what fundamentals have been signaling long before. Silver is now entering that phase. What we're witnessing is not just a rise in investor interest, but the early stages of a capital rotation into an asset that has been structurally undervalued for years. When the investment community moves, it does so in waves, first quietly, then forcefully. Right now, we are in that quiet but accelerating phase where informed money begins positioning ahead of the mainstream narrative. And this time, the catalyst is not fear or speculation alone. It is a recognition that the underlying supply and dynamics have shifted in a way that leaves very little margin for error. One of the strongest signals comes from the behavior of silver-backed ETF and ETP. These vehicles are absorbing physical supply at an increasingly aggressive pace, effectively removing silver from the open marketplace. When investors allocate capital to these instruments, the silver is taken off exchanges and placed into custodial vaults, where it often remains locked for long periods. This dynamic tightens available float and creates a kind of demand ratchet, a mechanism where every new inflow compresses the liquidity of an already constrained market. As inventories thin, even moderate new demand has an outsized effect on price discovery. Investors are beginning to understand this asymmetry, and their actions reflect it. We're also seeing a shift in the type of investor stepping into the silver market. Historically, silver attracted retail participants, commodity traders, and precious metals enthusiasts. Today, the profile is changing. Family offices, institutional allocators, and macro funds are beginning to treat silver not merely as a precious metal, but as a dual identity asset, part industrial, critical commodity, part monetary hedge. This duality is rare, and it creates a diversification quality that is increasingly valuable in a macro landscape defined by currency volatility, geopolitical realignments, and reindustrialization trends. Speculative positioning in the futures market also reveals something important. When speculative long positions rise alongside shrinking inventories, it signals that traders are not simply chasing momentum. They are anticipating a structural price repricing. But what is even more telling is the behavior during pullbacks. Instead of liquidation cascades, we're seeing shallow retracements quickly absorbed by renewed buying. That pattern suggests a shift from short-term trading to medium and long-term strategic accumulation. In markets where supply tightens and demand broadens, this kind of buying behavior often precedes large and persistent price moves. Behind the scenes, something else is happening, a psychological revaluation. Investors are beginning to view silver through a lens similar to how they perceive high-growth technologies. When an asset sits at the intersection of multiple exponential adoption curves, solar, artificial intelligence, EVs, semiconductors, its monetary interpretation changes. Silver is no longer merely a store of value. It becomes a claim on future technological expansion. And when markets reprice an asset based on its role in the future rather than its role in the past, the shift in perception can be as powerful as the shift in fundamentals. Another factor heating up speculative demand is the compression in the gold-to-silver ratio. Historically, when this ratio stretches far beyond historical norms, mean reversion follows. Investors who study macro cycles recognize that silver tends to outperform gold in periods where industrial demand rises and risk appetite rotates toward undervalued hard assets. As the ratio begins to tighten, it becomes a signal, almost a trigger, for capital to rotate into silver in anticipation of accelerated outperformance, and this mechanism is playing out again. What makes this moment different is that the investment community is responding not only to price but to scarcity. When an asset with inelastic supply begins meeting surging demand from both industrial users and financial investors, markets begin to sense the possibility of a squeeze, whether slow, burning, or sudden. Investors aren't waiting for the squeeze to be obvious, they are positioning as the pieces fall into place. If the past few cycles have taught us anything, it's that the market often moves long before the narrative catches up. When you evaluate silver through a macro lens rather than a traditional commodities framework, something becomes immediately clear. The tailwinds forming behind it are not temporary. They are the result of long-term structural shifts in the global monetary system, geopolitical realignment, and a rapidly changing economic paradigm. Silver is positioned at the intersection of these shifts, benefiting from forces that are bigger than any one cycle. What we're seeing is a convergence, one that aligns monetary policy trends, global liquidity patterns, and the reconfiguration of supply chains in a way that inevitably strengthens silver's appeal. A major driver is the direction of real interest rates. Historically, silver thrives when real rates are low or negative because the opportunity cost of holding non-yielding assets declines. But unlike past cycles where falling real rates were tied to economic weakness, the current environment is more complex. As governments expand fiscal spending to support industrial policy, clean energy transitions, infrastructure rebuilding, and technological competition, the pressure on central banks to maintain accommodative financial conditions grows. Even when headline rates remain elevated, inflationary undercurrents can keep real rates compressed. In this kind of environment, assets linked to scarcity, like silver, are naturally revalued upward. Global liquidity is another force pushing silver forward. Despite tighter policies in some regions, the overall trend across major economies leans toward stimulus-driven growth models. Central banks may shift posture, but governments continue fueling large-scale spending. When liquidity expands at the sovereign level, monetary assets often react with significant appreciation. Silver, because it functions both as an industrial metal and a monetary alternative, becomes uniquely sensitive to liquidity cycles. It absorbs the benefits from both sides, rising industrial demand and rising investment demand. Currency dynamics also play a significant role. As the global economy transitions into a more multipolar monetary system, reliance on a single reserve currency becomes less stable. Economies begin diversifying, hedging against currency volatility and geopolitical risk. This environment breeds a stronger preference for hard assets with international demand. Gold traditionally captures most of that flow, but silver, thanks to its lower price point and rapidly expanding industrial rollies, beginning to attract parallel streams of capital. When currencies fluctuate or weaken, silver's purchasing power often strengthens, making it a shelter during periods of financial uncertainty. Geopolitical fragmentation further amplifies silver's macro appeal. Countries are shifting supply chains, reshoring production, and reducing dependence on single points of failure. These transitions require massive investments in technology, manufacturing, and energy infrastructure, all sectors that inherently boost silver demand. At the same time, Geopolitical tensions create risk-off moments where investors seek resilient assets. Silver, with its dual identity, becomes a beneficiary of both risk-off hedging and risk-on industrial expansion. Very few assets perform well on both sides of that spectrum. Another powerful tailwind is the trend toward long-term inflationary pressure. While inflation may not surge continuously, structural inflation emerges when economies invest heavily in transformation. Electrification, AI-driven industries, renewable energy, and defense capacity. These transitions create persistent demand for raw materials, particularly those that cannot be easily substituted. Silver becomes a natural hedge, not only against monetary inflation, but also technological inflation, where the value of certain critical materials rises as industries scale. Even institutional behavior is shifting. For decades, silver received limited attention from major allocators despite being highly liquid and globally traded. That's changing. Commodity allocations in diversified portfolios are rising as institutions recognize that we're in an era of resource constraints. With industrial metals becoming central to national strategies, silver's place in long-term asset allocation models strengthens. Once institutional flows begin, they rarely reverse quickly because they're based on multi-year investment frameworks, not short-term speculation. The most compelling part of the macro story is that all of these forces, real rates, liquidity, currency trends, geopolitical restructuring, inflationary pressure, and institutional participation, are moving in the same direction. They reinforce one another, and when multiple macro forces align around an asset that also faces structural supply constraints, the result is not gradual revaluation, it is exponential repricing.